Hey everyone, I'm Peter. All right, so why should you care about the data that we're going to walk through on pre-seed? We think we have the biggest database of safes and notes in the world. We have nearly 500,000 signed since 2018, so we think that's pretty good. There's other great data sources out there. It's very difficult for them to see safes and notes, and given that so much of your work is over those two instruments, we think that this is pretty useful. So we'll go through pre-seed benchmarks. We'll talk about what's happening to pre-seed teams in the inception stage, and then what, if anything, is happening on seed that you need to know. And I'll note up front, the definitions of pre-seed and seed would be a whole other presentation. I'm sure yours will differ from mine. Please accept my apologies. So benchmarks. Everyone knows that investing on safes and notes has sort of exploded over the past, call it 6 or 7 years. That's very true. It saw an absolute surge in 2021. A bit of a decline, or holding constant in terms of money invested on safes or notes before any priced funding, but a bit of a decline last year in the actual total number of instruments signed. And then if you narrow that, if you say, wait, what about pre-seed specifically? And by pre-seed, I'll introduce this definition of between 500 and 2 million raised. I understand that many of you will judge that on product, not on capital. We can't see the product, so we have to put these guidelines down somewhere. So we think this is a reasonable definition. You can see that actually there's been a decline basically since 2021 and a pretty sharp, steeper decline in 2025. So this is a story that is repeated across every single part of venture. More money, fewer companies. That has been the story for the last, call it 18 months. Everybody uses safes. Any of you still use notes for fun? Yeah, why not? Interest rates, they're super fun. What kind of safes? Post money, because YC told us to, and valuation cap only. Why don't more of you insist on a valuation cap and a discount? 25% of these companies will convert below the cap, I think, ish, based on our latest data. So if I was an investor, I would want both terms. I realize that's not quite as easy and founder-friendly, but I would want both terms, by the way. And then we get to the valuations cap question, not valuations, of course. The big things from these data to me is that people are raising all over the place. Yes, it kind of defaults to these big round numbers. If you raise $1 million, it's typically on a 10 million cap. You've sold 10% of the business. These are round, simple, easy facts. But the black lines to me are the more illustrative points. Whereas like if you're raising $2 million, you might raise on a 9 million cap, you might raise on a 25 million cap. It is entirely dependent on who they are. Who you are, of course, as the investor, but more about who they are, because it's the demand that you're fading against if they have any other safes or term sheets out there. So to call this market efficient, I think would be a bit of a misnomer. And then when I talk to entrepreneurs, I'm always focused a little bit more on the dilution side rather than the simple valuations to say, yes, if you raise $1 million and a 10 million post-money cap, you probably, give or take the option pool, have sold about 10% of your business. But there are entrepreneurs who are doing deals at much higher and much lower levels all across the stack. And because so many companies are now raising multiple rounds on safes, which I gotta be honest, I thought I was cool with, and now I don't think it's good. I think many investors should push their founders to do price rounds earlier. Price rounds are not bad things. I get why it's simple and it's easy and it feels like you're avoiding legal fees, but you're really not. You're just kicking them down the road. Price rounds are better than safes. Start with safes. Safes are awesome, but 3, 4, there are companies on Carta with 13 different valuation caps before they get to priced. Like, this is an epidemic. We got to stand for something. And then some of this is because of the accelerators. So YC and A16Z Speedrun are now doing collectively how many companies a year? Anyone? Like 900, close to 1,000? That is a massive part of the market into which you are playing, right? So by just volume stages, they are setting benchmarks. And their benchmarks are, of course, 7% for 125,000 plus the 350K to get you to that round 500 number. If you math it out, and we have a ton of YC companies on the platform, you're selling between 8 and 9% for $500,000. That's what their deal ends up being most of the time. They also skip pre-seed. They kind of sometimes skip seed. And they're now, if you all saw Dalton's note, they want them to go straight to A occasionally if they have the figures. That has a massive impact on the pools that you're thinking about, right? That is a valid option for many founders, especially founders who come from less networked backgrounds. And of course, raising in one place is not quite the same as raising in another, although the medians do tend to default to these big round numbers. Across the Bay, New York, LA, et cetera, down the line, you can see there's a right tail that basically only exists in the super mature markets, and there's a left-hand tail that exists in other places. So where you raise matters. That is for sure. I do not recommend, by the way, that all founders move to San Francisco. That's not always the right choice. But they should visit sometimes. All right. Many of you are investing into AI, of course, but what type, what flavor, which part of the economy, it varies. So you've got all these different bubbles. Each one of them is a sector. The further to the right, the higher the val cap. The further to the vertical axis is the amount that they've raised. I've limited this to about $1 million to $2 million raised, so it's a pretty narrow snapshot. One note, there's differences. These bubbles move around every time I pull it, depending on the year, depending on the quarter. What's not different is that the dilution, the invisible axis that they're riding along, which is that 10 to 15% dilution, doesn't really change very often. That seems pretty stable.
Just a quick question on that.
Yeah.
What has changed in those sectors in the biggest way, obviously besides the big bubble?
You mean this globe sun that's about to erase us all? Yeah.
Has anything else significantly moved over time in your analysis?
Yeah, I think one of the biggest things that we've seen is that if you had looked at this chart in 2019, about 18% of the capital was going to the combination of bio, hardware, and like materials or energy, and now it's 36. So that is a pretty large shift. Every year, more and more of the physical world gets funded by VCs. Some of that I think is out of fear that my software portfolio is not doing so hot. Gotta go look for moats. But some of that I think is a natural shift back towards building with atoms. So I think that's actually pretty cool. The one place, by the way, that does not, of the physical world, that does not seem to be getting more funding in this environment is medical devices. Really hard. They always are like near the lower part of the left circle there. I guess the combination of building physical things plus incredibly high regulation kind of depresses investor appetites. But that makes me sad as a perhaps potential consumer of those things later on. Discounts, as I mentioned, I would use them, but when they're used, nobody negotiates them. They just say 20%, like all the time. You debate back and forth on the val cap, nobody cares about the discount. It's the unloved stepchild. All right, so now we get to founders. I think there's been some really big shifts in how these companies are being born, their early decisions around their teams, and their cap tables, perhaps even before you see them, right? So the first one is lots of solo founders in the ecosystem right now, more than we have ever seen. One out of every 3 founders that joins Carta these days is a solo-founded company. You are not funding them nearly to the extent that they exist in the ecosystem. So only 20% of funded companies are solos. I think that's some of the solos not wanting funding. They're probably not building venture-backed businesses. And then there's probably some lingering, shade at the solo founders. Do you all back solo founders? Have solo founders in your portfolio? Nods. Okay. Who's brave enough to say no? Good. Yeah. Good. Don't say it out loud. But it's clearly true. It's all right. And then how do they split up their equity? The YC dogma, which by the way is not true if you actually go read their documents. Gary and I went back and forth on this on Twitter. He does not believe that equal is best. He thinks slightly unequal is best. So when founders come back to you and say, we split equally because YC told us to, you can say that's not actually what they think. But splitting equally is the trend, right? More and more companies just end up splitting equally. It's easiest to split equally if it's 50-50. That's pretty simple. You still pretty rare to find 33, 33, 33, or even 25% each. That's still pretty rare. But Anthropic split equally and they have 7, so that worked out for them. It can always work out. If you don't split equally, it's 51-49 with the bigger share going to the CEO. And then 3, 4, 5 founder companies, there's just like an outsized portion that goes to the CEO, almost always. This is all data before they raise money, by the way. So one of the big things that I talk about with all the accelerator founders is, look, I know it's silly, and I know you probably hate it, but put your shares on a vesting schedule. Stop creating companies that don't have vesting schedules for founders, because about 35% of them will lose a co-founder in the first 4 to 5 years. Co-founder breakups are pretty common. And when that happens and there's no vesting schedule, they ruin the ability for them to talk to you folks and get money. That is an easy way to kill your company. The big question is, how long should those vesting schedules be? So the traditional was 4 years. We are seeing a trend towards more 5 and 6 year vesting for founders, just in alignment with how long this journey is going to take. I think that's a pretty good sign. If a founder comes in, they're on a 6 year vesting, I think that's a little check mark for you, probably. We're also seeing a lot of investors ask for revesting along the way. Probably, maybe not you all at pre-seed, but seed and A, we're hearing that a lot more than we used to. We got to get on the same timeline. Not a full revest, but a partial revest along the way. And then let's to the teams. So this is the employee pool, starting at about 10%, 8 to 10% when you see them, all the way up to 20% when they're really big and mature. I know you all wouldn't do this in this room, but I do consistently hear VCs at your stage suggesting to founders that they should set aside 20% of the equity for the option pool. It's just way too much. They do not need to. They are not going to spend 20% of their equity on employees in the first 5 years. It's not happening. In fact, given the way these teams are trending, they might not spend it in the first 10 years. So option pools, I think, are actually probably too big and could come down if they really wanted to. What are you paying engineers, or first hires? 1.5% for the first hire at a tech startup is the median out of last year. Up to 4, down to half. It's all over the place. Yeah. So if your founders are wondering, hey, I'm hiring an initial team, what do I pay these people in equity? We've got pretty good benchmarks for that. Engineers make a little bit more. About 6 out of 10 employees at the early stage are engineers, the first 10 hires in our data. So let's talk about team sizes. First thing, founders are just putting off hiring for a lot longer than they used to. They're just building just the founders only, right? It used to be you'd hire your first employee in about a year. Now it could be a year and a half to 2 years before you hire an employee. Second thing, hiring across the board at startups has completely dropped off. So the black line is new hires per month. 75,000 at the beginning of 2022, 31,000 at the beginning of 2025. That's across all 60,000 companies on Carta. That's a massive shift. And now you could say, okay, but that's okay if this is basically back down to where it was in 2019. All right. There's a lot more companies on Carta today than there was then. And look at this orange line. That's people leaving or getting laid off. Basically, headcount across this entire industry has been flat for the last 2.5 years. But funding has risen. We have never seen a period of time that funding has risen like this and headcount has remained flat. Those two metrics almost always move in unison. They are no longer moving in unison. So yes, is most of this just a story of overhiring in 21 and 22 and making up for those mistakes? Sure. But I think anyone who's looking at the block thing and saying, Jack just made mistakes 5 years ago and making up for it, I don't believe it. AI is a real thing. And there's going to be more of this coming. Yeah.
There's a lot more companies also coming out.
There's a lot more companies.
Small teams.
I do not think that the number of new companies and new founders will ever get close to the number of layoffs. Most employees do not want to be founders. I wish that wasn't the case, right? We hope for 1,000 more flowers to bloom. I do not, yes, it's rising. It's not rising nearly to the same extent. I just don't think it will. And part of that is these are the number of people that work on these companies. So it used to be 10 or 11 people at a seed stage. Now the median is 6. 25 at Series A, now the median is 17. And this year, this actual median is 13 so far for the companies that have raised. So it is dropping fast. Yeah.
Does that mean salaries have gone up, runway is longer? Do you have data around what the implications of all that are?
It's a great question. I don't have the salary graph. Salaries are rising a little bit, but not keeping pace with inflation, or they haven't over the last 3 years. And the weird part is you would think, all right, fewer employees, each one of them could get a bigger slice of pie. Equity packages are down by half. There have been a 50% cut in the average equity package for a startup employee over the last 3 years. Yeah.
Are these all venture-backed companies?
Yes. Yeah. Or the vast majority of them. Yeah. Which is weird, right? 50% headcount or haircut in equity. What's going on? I thought there was joy and excitement around the ecosystem. Well, if you're an AI ML engineer, then yes, you get to demand your price. Call it what you want. But if you're your lowly content marketer, it's a tough world out there. I'm not trying to sugarcoat it. People are holding on to part of the reason why this graph is odd is because usually this orange line is driven by people departing by choice and people getting laid off. The number of people departing by choice is way down. People are sticking at their roles. If I have a good job, what I'm trying to do is keep it, not the great resignation, let me bounce, bounce, bounce. Uneasy, honestly, for a lot of startups or startup employees that we talk to. That was depressing. Yes, so are they using contractors? Are they filling it with part-time? We can see a little bit of that. The answer is yes, they're doing more, but not to the same extent. Again, a little bit more outsourcing as well to other countries. All right, seed competition. So first off, let's define some terms. Nobody has any idea what pre-seed or seed are. They mean whatever you want them to mean. You can raise $2 billion seed rounds. You can raise $200,000 seed rounds. Pick your poison. What I can say is under our definitions of seed, which is, again, if you say priced equity rounds that are seed rounds, we can see the docs, we know that. And then on safes, anything from $2 to $6 million is a seed round. Fungibility there, I understand. But if you have those two definitions and then you look at how much money is raised in seed rounds versus the number of seed rounds actually raised, the same pattern emerges. More capital, higher valuations, fewer companies. Concentration is not just a Thrive Capital late stage game. It is happening at the early stages too. And why is that happening? Because the valuations have gotten pretty bonkers. So on the top 5%, it's 80 million bucks as the post money for a seed round versus the median of 20. And so, 3, 4, 5 years ago, the gap between those two, the median and the top 5%, was about 3x. Now it's 4x and rising fast. So again, the accumulation of capital, attention, excitement, et cetera, to the top 5 and 10% of companies has gotten faster, and it's speeding up. How much money do you need to raise these rounds? Nobody knows. It's all over the place. This is data from Silicon Valley Bank, and it's not quite ARR. I couldn't nail down their definition exactly, but suffice it to say, you raise rounds at all sorts of varying revenue levels. I'm sure that's one of the things your entrepreneurs ask you all the time. What is the benchmarks? Tell me the benchmarks. There's two honest answers to that. The first is I don't know, and the second is the absolute dollar value doesn't matter, the growth rate does. Those are only the really two honest answers. In seed rounds, people are selling about 20% of the company, a little down actually, 19, 20% on average. Bio, pharma, a little bit more. But that's pretty healthy and very much in line with historical averages. It's not like dilution has gone up at all, really. By the way, this is mostly to the discussion earlier around follow-ons, reserves, checks, et cetera. One of the biggest shifts we have seen is that the lead of a seed round used to take about 50% of the seed. Now on median, they take 60%. And in 1 out of 10 cases last year, the seed round was taken by one investor only with like a little bit of angel checks. So seed is getting more sharp elbowed. There's not as much room on these cap tables for everybody to have a little bit of allocation. The gap between the time. So if you're advising your entrepreneurs, how long is it going to take you between your seed and your A and your B, et cetera? The median time was rising over the last few years, but has turned over the last 3 or 4 quarters. Some of that is the companies that raised during that time where the line was rising have started to shut down. And so they no longer count in the data set. But there is, I think, a little bit of health returning. So if you look at it in terms of time between rounds, or if you look at it in terms of graduation rate, this is a kind of hard chart to read, so I'm going to narrow it down. Percent of companies that go from seed to A at various timescales. So at Q8, which is 24 months after your seed round, about 17% of companies have gotten to Series A at that point. In the boom times, it was 40%. So yes, graduation rates have definitely come down. It's a lot harder. But they're starting to perk back up a little bit. So I think in the end, in the long tail of history, what is a reasonable expectation on this side? Something between 28 and 30, 35%. So 1 out of 3 companies will get from seed to A. There'll be a lot of stranded seed companies. I'm realizing this is a more depressing presentation than I anticipated as I'm thinking about it. Okay, so why is everyone freaking out and also elated? I mean, this is the easy answer, right? When you can go from $1 million to $1 billion in revenue in 2 years, or Anthropic adding 14 billion in a year. It's not as though all of you are looking for the next Cursor, the next Anthropic necessarily. But what it does is all the people that are going to fund your companies up the stack, they have redefined what good looks like. Good is now okay, great is now good, and fantastic is now Anthropic. Like that's a complete redefinition of what the best is. And when that happens, I don't care what part of venture you're investing in, it does impact you because it impacts the funds that are going to buy your companies or fund them for the next round, mark them up. Last note on seed, there's just like a special sort of frenzy that happens in San Francisco that doesn't really exist. Even in New York, it doesn't exist quite to the same extent, where the top 5% of valuations here are just like, you don't really find them in other places in the country. If I were an investor today, would I spend all my time in SF? I would not. I would try and go find those gems and bring them to SF once I funded them and told nobody about them. Okay, last two slides. First one, there's a talk here from Samuel and others about the mega funds versus the emerging managers and the bifurcation between the two. And I do think that there is a tendency, because I love emerging managers, you all love emerging managers, we're the best, and the right side of that equation, obviously, as a joke, to say the mega funds have no idea what they're doing and it's all bullshit. Not quite, right? If you are going to look for unicorns, paying at the highest valuation is the right decision. Hands down. Statistically, you will find more unicorns amongst the highest valued seed companies. And this is 2016 to 2020. So no, these are not companies that are minted as unicorns during their seed round, and I'm cheating with the math. This is just 5.6% of the companies in the highest quartile of valuations at seed became unicorns, whereas less than 1% did so at the lowest valuation at seed. So this market is completely inefficient, but it is not entirely illogical. Like, mega funds have a point. However, if instead you are not worried about that binary billion, not billion, but you look at it from a multiples basis, what percent of companies in each one of these tiers became 25 times more valuable than their seed price? You can find them everywhere. So your strategies, probably, if you're not going to play in the mega fund space, can totally work. What I would push you on is this. Who's going to buy them? Because they sure as hell aren't IPOing at $1 billion. They're not IPOing at $3 billion. They're going to be $5 to $8 billion minimum in order to get over the IPO bar if you're looking at the publics today. So if your strategy requires you to have a lot of companies purchased between $1 billion and $3 billion in valuation, that is tricky. Where are the exits? That's the biggest question. This math can totally work at so many parts of venture. The exits are the part that I don't understand as well. And on that depressing note, any questions?
Thank you for a great presentation. A lot of great numbers.
Where's it coming from? Oh, sorry.
Right in front of you.
The voice of God, yeah.
Yeah. Not quite that. Hey, so, a lot of great data, and if I were an LP in emerging managers or early stage funds, how would I interpret this? Is 2025, 2026 a great vintage, or is this going to be a troubled vintage?
Difficult to say. If you read, I don't know how many of you also follow Cambridge Associates, but they put out like an outlook for 2026. This was in January, I think. And literally the first paragraph was, if we were investing into seed stage as an LP, we would only choose exceptional managers. Super easy. Like, sounds awesome. What a great admonition. But I think there's a bit of truth in that. The state of play in venture is that there are so many more funds than there used to be. So the traditional argument from smaller funds has been, we can outperform on a multiples basis. That is still completely true. The top 5% of small funds will probably vastly outperform the top 5% of mega funds on a multiples basis. The problem is finding that top 5%. There are so many more managers you have to evaluate. So when we're talking to LPs, and LPs ask us for information and thoughts all the time, the point to me is that if you got to be confident that your manager selection process allows you to see what broadly mirrors the market and not as simply a local maxima, which I think a lot of LPs have trouble with. wrap all that up, I think that there will be more emerging managers started this year and next year in terms of fund ones than there have been in the last couple. I think that will get slightly better. On the downside, something like 25 to 40% of VC funds this is the last fund they'll raise. If you look at the data from Stepstone, it was like, of the close to 1,000 funds raised in 21 and 22, how many of them are raised fund 2? Like 1 in 10. That is too low. We'll do a little bit better than that, but just like the graduation rates for companies, what happens to startups ripples through venture like a tail whip about 2 or 3 years later. So, somebody asked me a question I can be optimistic on. Yeah.
So one slide you did not have is what do the exits look like for acquisition?
Yeah.
I mean, they used to be primarily between 150 and 300 million, was the majority used to fall in. What do you see now?
Yeah, I don't have it by valuation, but I should. That's a great push. What I can tell you is that 2025 was the best year for exits we've ever seen on Carta, but the vast majority of them were quite small companies, pre-seed, seed, Series A.
So like 50-ish.
Yeah, we'll call it 100 cap. The fallow ground, better. I mean, it wasn't a bad year by any means for, call it Series B, Series C growth acquisitions, but it wasn't some blowout year. It was basically flat or a little bit up from the year before. Whereas acquisitions at pre-seed and seed really took a very sharp uptick last year. I think that's mostly tiny talent tuck-ins, acqui-hires, that kind of stuff.
Yeah, what we also see is bigger funds, basically the companies that are dying, they basically merge them into their other portfolio company, and then they don't have to write it off. So
Yeah. There was a point earlier about, is PE coming to save the unicorns that died? No. Maybe strip the graveyards, but they're not going to save anybody. Yeah.
You talked a little bit about the seed funds, pre-seed funds, top 5% rate.
Yep.
Have you done, other than just performance of that person's fund before, have you done any type of research trying to figure out what are those causal or correlative data points saying funds like this perform, or we would predict them to be a higher likelihood of performance, like psychographic, demographic?
You think we would just give that data out? In a conversation like this?
Question for everybody in the room?
Yeah, so the question was, have we done any psychographic, demographic, historiography on the funds that we think are most likely to succeed? The answer is no, we have not done that. No, but we actually haven't. We really have not, I promise. Yeah. We should, though. That's a great idea. I would like another researcher on my team. Henry, if you're listening. Yeah.
Do you guys see or track data on pre-seed seed managers getting liquidity into growth rounds?
Yes, so we're starting to, this is a great question. We would ask that a bunch last year, and we didn't have the data on it, but we're starting to get data on it. So we should actually have a report out pretty soon on what we think is happening on investor secondaries. So 2 basic events that we see there: investors participating in tenders, or in the tender process, sometimes as a slightly separate event, but sometimes actually in the core tender itself. And then investors simply executing what we would call bilateral secondary transactions. Bilateral secondaries were higher last year than at any point since 21. And tender offer participation was also quite up. So yes, it's happening more frequently. The question for me is, again, I think secondaries are going to be a big exit part of the market for a long time. When you look at the actual demand for secondaries, however, it is almost more power law than venture itself. Like 5 companies demand 50 to 60% of all secondary capital activity. And we can all list those companies. Interesting question. What happens when those companies IPO? Does the secondary demand flow to names 5 through 20? Or does it just retreat? I don't know that. My instinct is that it would actually flow down the stack, and I'm hoping that that's the case, but I don't know. I thought this year was supposed to, according to every banker I talked to, this was year supposed to be amazing for IPOs. How many have we had so far? None? 0? We're all waiting. Come on, SpaceX. Yeah.
2 questions. One, how many years into the average pre-seed fund does the TVPI and the DPI normalize at exit? Is there a high watermark normally on TVPI?
There's not. I mean, it becomes 100% correlative at the moment of where the fund ends, so that makes sense. But in terms of when does it stop jumping between quartiles and things like that, it's about year 6 for when we back tested this. It might actually be a little bit longer than that now, but year 6, year 7, if you're a top quartile fund at year 6 or year 7, the likelihood of you dropping to a very low quartile is much, much, much lower. And then, of course, if you're a low fund at that point, getting up to the highest quartiles is also much harder.
And is there anything in the data about like my fund, just every week I have like 1 to 2 Series A's. It feels very cycle toppy.
Yeah.
Do funds like that perform better, or like is it like is there any data there around like
Do funds that have more
is my
Series
fund
A's
just
than
gonna
not
explode?
Series A's?
Yeah, like is it just gonna like yeah? Like,
Are you
know what I
asking
mean?
if you're a good investor? I think yes.
No, because like I was at a thing last night and someone
Yeah.
described it as you're the cycle top fund, and I'm like, oh, great.
Hey man, it pays. Yeah.
What is that like? What does the data show there for like the 21 vintage of like really like frothy funds?
Yeah. I mean, I think this is, again, an argument that's being had across the ecosystem. Like, is one of the core strategies now of being an emerging manager just being the feeder system into the mega funds? And, like, you're playing that game, and can that game work? It's certainly working now, right? Will it work for ultimate DPI? I think is open question. I just think that people talk about venture as though it's this craft industry where it really hasn't been for a long time. Like, it is an institutional asset class now. No matter what, like, it doesn't feel that way at the very, very early stages. I get that. But, like, there's so much more money available to these companies now. So, like, being a part of that conveyor belt is going to be very difficult to win if you're not at least somewhere a part of it. You don't want to be anti-consensus. You want to be pre-consensus. But hopefully that you all can stay close to the founders there. Yeah.
By the way, so what's the optimistic note for all of us here? I'm going to ask you that question because
Yeah. Optimistic note for me comes down to 2 things. One, like the cost of company creation is going to 0, right? Now that feels in some ways optimistic and pessimistic because then how do you build moats? But that's literally what you are for, right? Finding the founders amongst the many, 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 many new founders who are hopefully off the mega fund roadmap who can build the distribution and build the moat. So I think that there's going to be a lot more founders to choose from, which is really cool. The second thing that is optimistic to me is these businesses, and you can be a point of the spear here, these businesses do not need to have the same capital structure as the businesses that came before them. Like, look at the team sizes. Yes, they're spending that money on compute today. Will they always be spending that money on compute in the same way? Will the compute costs always be equal to what the employee costs used to be? I bet not, especially if you can go multi-model, et cetera. So I think that you're going to be able to build amazing companies with amazing growth rates that are just far more capital efficient if they're really trying. And then we talk about exits. I am interested to see if there's venture investors who are going to start doing revenue sharing model or like try to build a different kind of model. A couple years ago, there was the seed strapping idea where you raise 1 round, et cetera. Like, aside from Bryce Roberts at NDVC, I'm not hearing a lot about it anymore. I hope that there are more interesting, different, kind of odd models for you all to try. I realize that's very difficult to pitch to LPs. So that's probably the hardest part. Yeah.
A lot of founders, sometimes when they raise their kind of first round of capital, there's this, hey, do I raise money from a multi-stage fund
Yeah.
around signaling? Have you found that signaling is like a thing, like don't raise because that they don't? Have you seen it actually be an issue, or if there's any data around this topic?
Yeah. I do hear it a lot from emerging managers mostly. So the idea is that raising from a mega fund is good if you are great, but the moment you're not great, they will just discard you like a toy. And you'll be the back part of the Andreessen portfolio, and you won't get any love, and nobody's going to pick up your calls, and you just won't matter. And because they won't lead your Series A, that's a big problem, right? Because they have the money. I think it is a fair pushback. I don't have a ton of data as to whether or not it's actually true. Have there been a bunch of orphaned companies? And then the other part of me says, the other thing that goes around venture is, most venture investors are just capital. The founders would have figured it out anyways. Okay, well, those 2 things are in direct conflict, right? Is being an orphaned part of a portfolio a really big deal or not? Because if it is, then the investors really matter. But if it isn't, then they don't. My instinct is that for a lot of companies, it is a big deal. And if you cannot, especially when it comes to the seed to A transition, because these companies are more than happy, or these funds are more than happy to lead A's and B's, I think could be an issue. But I also understand the founders who go, screw it. Like, I'm trying to be a decacorn. This is the best way to do it. So I literally think there is no right answer there. It's just about whether or not you're aligned to what the founder is thinking. How many of you have to compete with mega funds with term sheets? trying to get in early. The rest of you are trying to get in earlier than that. Yeah.
Oh, yeah, we got one here in the corner.
So I had an LP composition question.
Yeah.
I've been seeing this trend of more multi-stage firms investing in pre-seed funds,
Yeah.
mostly for sourcing. Is that something you guys have seen in the data?
Yes.
Any number like
it's a great question, and the answer is yes. Yeah.
any understanding like the degree of change or how prevalent it is?
It's fairly prevalent. It's not like it grew 100% last year, right? It hasn't become twice as common as it used to be. In terms of the LP composition, what we tend to see, so we break this out by fund size. Funds that are $25 million or less, typically the composition base is still a lot of high net worths, some family offices, and then 1 to 2 institutionals. Occasionally, sometimes no institutionals. And then there are funds in which there's basically no anchor, where there's 3, 4, 5 different parts of the LP base that are basically the same size. Once you get over 25 million, there is usually an anchor. So 25 to 100, there's typically an anchor. That anchor takes between 20 and 25% occasionally. And that anchor is usually an institution. The institutions themselves, there are some of whom have dedicated emerging manager programs, and they're here for the long term. Just like the high net worth individuals, though, there are some institutions who kind of got into venture for the first time in 2020 and 21. And they are reticent to re-up in some cases. So I think the most underexplored part of the venture LP community is not necessarily the mega funds, it's the family offices. I think that there's going to be a whole redo of how families' offices are making themselves available to you, and what has traditionally been a very opaque thing is going to get more transparent over the next 5 years. So I'm hoping that's a new kind of better source of capital.